Let's talk about the income statement, also sometimes called the profit and loss statement or the P&L or the operating statement. And the point of this statement is that owners and other stakeholders need periodic information about how the company is doing in terms of profit. And the income statement shows revenue and expenses for a given period so that you can match revenue to expenses for the period and you can tell what profit is left over. And here are the major line items of a sample income statement for an insurance carrier. And just real quickly, here's an important concept to keep in mind about the income statement. It's done for a specific period of time, and you're matching the revenues that were generated in that period of time with the expenses that were also incurred in that same period of time. The expenses that it took to produce the stuff that you sold or provide the service. And that's called the matching principle. In insurance finance, the matching principle is critical because when you book a claim versus when you actually pay out the claim in cash, they don't always happen at the same time. Okay, the first section that you see in this income statement is revenues. And there are two parts here. The revenue earned from the underwriting side of the business and the investment income from the invested assets, which are often a big part of an insurance company's revenues. And the premium number is not written premium, but earned premiums. So for example, in the case of a split year policy that doesn't start on January 1st, maybe it starts on June 30th, halfway through the policy year. At the end of the actual fiscal year, when you close the books, you won't have earned all of the written premium, you've earned half of it. So you earn the written premium as you provide the coverage. And notice that we have a column on the right, percent of revenue, that relates to the line items as a percentage of total revenue. So net premiums earned in this example is 74% of total revenues. And then we've got expenses. And the first line is insurance claims and claims expense. These are incurred losses, and they're defined as your paid loss plus the paid loss adjustment expense, both allocated and unallocated, plus any changes in case reserves, which are reserves or cases that you know about, and changes in IBNR reserves. And IBNR just stands for incurred but not reported. And then you have amortization of deferred policy acquisition costs. This is the portion, mainly commissions, that you would put on the balance sheet until you've matched them or amortized them to earned premiums, back to the matching principle. And the other insurance operating costs and expenses would be things like underwriter salaries, training, insurance-specific advertising, things like that. And then investment expenses are related to the investment income that you've earned. And corporate level expenses would be things like rent or corporate level advertising. Income taxes are taken out, of course, and then you're left with net profit, the bottom line, which in this example is 18% of the total revenue. And after it's all said and done on the income statement, net income goes to one of two places: retained earnings on the balance sheet, which is money that you're putting back into the company, you're retaining in the company, or dividends, which are distributions to shareholders who are the owners of the company. And if you were to look at net income specifically related to underwriting, then we look at the revenues and direct expenses that are related to underwriting as highlighted here. And we could do the same thing for the investment side of the company as highlighted here. And another couple of points related to the income statement. It's important to remember that the income statement is, for many companies, not done just on a cash basis. That is, profit could actually be different than cash flows we talked about earlier. And this is for several reasons. We listed a few of them here. Profits subtract depreciation, which are actually a non-cash expense. Profits ignore cash on new capital that you've spent, and that expense is capitalized and then depreciated as you use the asset. And profit records income and expense at the time of sales, not necessarily only when the cash exchange actually occurs. And profits do not consider changes of working capital, things like receivables and payables. Okay, that's a quick overview of the income statement.